Hi everyone, welcome to this week's edition of Midweek Market Update. I'm Ashley Rosser of Victory Fiduciary, and today what I wanted to get into is just kind of going over the fundamentals of the economy, what we're seeing, kind of where markets are at this point as we're midway through the year. Many analysts will say that this is one of the worst starts to the year for most indexes that we've seen in 50 years. And so I know many of you probably opened up statements in early July looking at the last quarter's results, and you may have been wondering like, hey, what's going on? Maybe you were feeling some concern. And so what I really wanted to do was to take some time to just kind of go through where we are in terms of markets, where we are in terms of some of the fundamentals, and what it could mean for the future. And so bear market, just so you know, is anytime we are below 30%. We did hit bear market territory throughout last quarter. Some of those have improved since then. So this is where we stand though right now as of July 15th. So this right here is going to be Bitcoin down over 57%. And then looking at the NASDAQ here, down just under 19%. S&P 500 down 18%. Dow Jones Index down 13%. And so commodities right here is the only area where we have positive return of about 14%. And so bonds, another area, the bond aggregate, down almost 10% for the year. Pretty concerning and interesting when we think about the fact that bonds typically are areas of hedging. And so what we know that in the situation we're in inflation and rising interest rates, bonds typically do not do well in the short term. We're seeing that play out very clearly right now. So point being is that, I mean, really the broad-based markets are kind of down across every front. With this chart here, I just want to concentrate here on how often we see the S&P 500 down at least 20%. We see it every 2.5 years. Typically lasts about 183 days. Last time we went into a 20% correction was June 2022. So that was, we were down over 20% off the high. We were down over 25%. At one point in the month of June, but they're not completely out of the realm of normality. Like I said, we see them about every 2.5 years. They typically last about 180 days, which means we're pretty much kind of in that area now if we start to look at that pullback, which began really right at the beginning of the year in January. So obviously there's a lot of geopolitical strain that we're seeing. And I think that it's just helpful to kind of take a look at what this really kind of means globally. Obviously, we still have the war happening between Russia and Ukraine, which has created geopolitical tension. Also has called into question what Russia is going to do with sources of energy. Just saw today that Germany is talking about the need to potentially have to begin to ration fuel usage. It'll be interesting to see how that kind of plays out in Europe as well as kind of globally. So United States still has a significant portion of the overall worldwide GDP, 22.94 trillion. Closest one next would be China at 16.8 trillion. So United States really still is responsible for a significant portion of the GDP. And so I think one of the things that we're really going to need to be watching is just kind of this continuing potential for energy crisis, particularly if Russia continues to make threats about production and exports. Obviously, supply chain issues remain an issue due to China did go back into COVID lockdowns multiple times throughout this year. And then return to normal demand has come. So we're kind of like we have a super low supply right now of many things, but heightened demand because everybody says, but we just kind of want to get back to normal. We're still seeing significant shortages in the semiconductors, which is affecting electronics across the board, as well as cars, boats, really anything that requires those chips. We're seeing significant delays in getting them actually from the plants to the consumer. That's driving prices up significantly, as well as looking at other key resources like commodities and fossil fuels, and which is things that we kind of just discussed just a few minutes ago. Interesting. Bonds are on pace for their worst year in history, using the Bloomberg U.S. Aggregate Index of bonds. And so I already mentioned before that as of July 15th, bonds were down about 10%, which again is pretty startling when we realize that bonds are typically used as a hedge in portfolios to try and be able to ride out volatility. And so typically the more bonds you have, the more stable your portfolio may be. But this year it's really just kind of been across the board difficulties in finding areas of strength and outperformance. We still have a pretty significant labor shortage, and you'll know that. I mean, if you go into restaurants, you may see signs that say that they don't have the typical amount of employees. I know even here in the Jersey Shore area, the boardwalk having a significant issue in being able to staff their normal positions because of the number of positions that typically would come over from overseas. COVID kind of continues to prohibit that. And so we see 67% of small businesses are expected to be attempting to hire. This was back for the month of May. And so it's just been still difficult getting people back to work. So we continue just to have a labor crisis, which again will likely continue to impact the financial market here in the United States as businesses continue to try and keep up with demand. Something else that's been interesting is the 30-year fixed mortgage rate. We saw a significant jump just in the last month alone. So when the pandemic began, we were really flat. And I mean, we saw interest rates that were as low as we had seen in our careers. And so, but I don't know, hopefully you can see this here. There's a pretty startling increase in terms of interest rates. Although I think it's important to note, looking here, I mean, we're really kind of, when we look to being in the mid-5s or so, kind of like a more normal mortgage rate. So I know kind of when you're looking at where it was a month ago or 2 months ago or 3 months ago, it seems significantly high. But when we look at kind of back in history, we're kind of almost approaching back to a more normal rate, which could be a sign that if they stabilize there, that market has just kind of begin to price in some stabilization. But absolutely experiencing volatility, which again is likely going to have some sort of an impact on the housing market. It'll be interesting to see if people are willing to let go of mortgages they have right now if it's a lower rate. So it'll be interesting to see what happens to the supply portion, because remember, supply and demand rules everything. So if a lot of people are trying to buy, but nobody's listing their homes, those few homes that are on the market, those prices are still going to have to go up just because of supply and demand. So it'll be interesting to see what mortgage rates do to impact the actual market for real estate. So I wanted to just spend a couple minutes. You hear us talk about indexes. You hear us talk about the Dow Jones, the S&P, the NASDAQ. So here's the breakdown of some of the big names in the Dow Jones Index. And these are names that you've all heard of. Walt Disney World, Walmart, Visa, McDonald's, JP Morgan, Home Depot. Okay, so these are those staple companies that people a lot of times are using kind of regardless of circumstances. So just to kind of show you that these are big name companies. And so when you see kind of across the board, this is not just speculative companies that is experiencing this significant correction in markets. These are household names that when you talk about some of these names, Johnson & Johnson, Walgreens, Apple, these strong companies with strong earnings, strong fundamentals, kind of just right now being somewhat undervalued, which means that typically those areas are not going to stay like that forever. Talking about the top 5 companies in the main index here, which I just want to talk about the fact that the S&P 500 and the NASDAQ, top 5 companies are Apple, Microsoft, Amazon, Tesla, and Alphabet. And so there's a lot of overlap between the S&P and the NASDAQ. You see again though, those companies, companies with earnings which are likely to be coming out with new innovation, strong fundamentals, right now undervalued. Which brings me into this chart here. So the S&P 500. Now, if you've been following me since COVID-19 pandemic era, you'll remember that I was saying we got to be really careful here because the S&P 500 is significantly overvalued. We have to be really careful here because price to earnings ratios are like off the wall, completely overvalued, not sustainable pricing where we are with the S&P 500. We knew that we were going to see a devaluation come. I didn't know when, I didn't know exactly what day it was going to happen, didn't know how long it would take, but we were here for a long time. Well, when we look at price to earnings right now, the S&P 500, this is back in June, so it's actually probably a little lower than here. we're now here. We're now at a neutral or slightly undervalued for the S&P 500. Why is that relevant? Well, it's relevant because it means that it's likely that if enough of the steps come together, that we could be approaching a bottom in markets, meaning that markets can stabilize and then kind of almost like have a shelf to kind of hop off from. So this needed to happen. This happened very quickly. This happened literally over the course of a few months, where we saw a rapid devaluation of the S&P 500. Again, we weren't necessarily surprised because of how overvalued markets had become. We were waiting for what that catalyst was going to be. I didn't think it was going to be COVID-19 anymore because that had been priced in. What wasn't priced in was the Russia and Ukraine war and what was going on overseas, and then all those impacts that kind of began to have the trickle effects. That combined with inflation. So inflationary pressures have been huge on markets in terms of putting downward selling pressure, because as the cost of goods is increasing, it's lowering companies' what they're able to earn. So it's kind of like slashing off profits. It's harder for American people to just to go out and buy the things that they need every day to be able to go to work, fuel, basic food. We're seeing all these things increase, and so inflation is very scary for markets because they realize that that can really have a significant impact on a company's bottom line. So when we look at inflation, so that's why we've talked about the Federal Reserve needing to raise interest rates. That's necessary. Interest rates have been rock bottom for so long, almost like kind of like a Band-Aid, where the Federal Reserve has kind of been like nursing the economy, trying to give it a gentle landing. Okay, well now we're here, and inflation literally just kind of jumped in with 2 feet, said ta-da, and the Federal Reserve said, okay, well now we have to do something because we can't allow inflation to run hot unchecked, or it's going to become unbearable. Things will become completely unable for us to kind of sustain. So that's kind of where we are, and so I thought that it would just made sense to kind of go through where we are as markets. Now, we've seen a huge run up in the markets this week alone. I think that for the month of July, up over 7%, 8% for most of the markets. Is the bottom in? Are we done? I don't know for sure. I think that we're beginning to see some signs, some positive signs that things could recover. I'm not saying that we can't go lower from where we are now. We can. But I think that we're finally starting to see some technicals and fundamentals kind of align to say that we have a favorable environment that we could kind of move on from. And I just wanted to end with this because I think it's really important. I remember for the past 2 years I was showing you guys the chart, and next video that may make sense for me to bring back in, looking at kind of the cycles of markets. And remember that when investors become euphoric, that's typically the sign to say, woo, we're going to have a problem soon. And at the end, when everybody just is like, woe to me, this is the end of the world at the bottom, that typically is the sign that maybe a new bull market is getting ready to take a run. And so I like this quote: bull markets are born on pessimism, grow on skepticism, mature on optimism, and die on euphoria. And so we are kind of right now at the capitulation phase where everybody's kind of like, okay, I'm just going to give up. We are starting to get calls from clients who say, never mind, I just want to move my money to a savings account now. They've ridden out all this volatility, and now they're ready to throw in the towel. So we're having those conversations and discussions, and I think that it's important that typically when the investor attitude kind of shifts to there, can be a sign too that markets are kind of getting ready to make another move. Again, can't promise for sure that we're definitely at the bottom. Definitely seeing some encouraging signs. Biggest amount of advice that we give our clients right now is just that, making emotional changes based upon, where you were in January versus where you are now can be dangerous. You always want to make sure that you're allowing a rules-based process to kind of guide your next steps, not our emotions. I know it's easier said than done. Money is emotional. That's the way that it is. We all work hard for it. Really important, I think, now more than ever, to make sure you have a trusted fiduciary who can kind of help guide you through the process. Because it's one thing when you can kind of throw a dart at the wall and everybody's making money. And that was the market we were in for 2 years. Now things are a little tougher. You have to really understand what role positions should be having in your portfolio, kind of giving them jobs. And if they're not fulfilling those jobs anymore, being willing to fire them, cut them out, and bring on new ones. So I thank you for joining us. Can't wait. We've been real busy the last 2 weeks recording our summer school session, where we are bringing in local industry experts in a wide variety of areas to bring you relevant advice and information regarding your total ability to grow and protect your wealth. So super excited about that. We had mortgage expert in here, credit and debt repair expert, realtor, and a estate planning attorney coming in to really give us some great tips. So can't wait to begin putting them out for you very soon. Again, I'm Ashley Rosser of Victory Fiduciary. We thank you so much for joining us. Have a great day.